Thanks for tuning into Talking Point. I'm your host, Niraj Shah. Terms like contrarian investing have always intrigued me simply because uh, I sometimes get baffled about how is it that people are betting on a theme that is maybe out 2 years, 3 years out, and the certainty of that. But what at times contrarian investing or not following the herd or not chasing quality at any price does is that it helps you protect your downside. It helps you not make too many mistakes. And in the words of our guest on the show today, not making too many mistakes by itself can actually lead to a fairly healthy performance in the equity markets because the upsides take care of themselves. Well, the question mark, therefore, the question to our guest, Mr. E. Sundaram of O3 Capital on the show today would be, what are his learnings out of the 29 years of equity investing experience that he's had, and how is he putting them to use in the current context? Mr. Sundaram, good having you. Thanks so much for joining in. Good having you. Hope all is safe.
Thank you, and thanks for inviting me.
The pleasure is ours. In a nutshell, though, tell us about O3 Capital. We haven't heard too much about it. So, what do you do at O3 Capital? I presume it's a PMS firm.
O3 Capitals, the origin was in 2007. It's an investment bank, second-tier investment bank, focusing on four verticals. In 2017, they diversified into managing investments for clients. So the first thing was passive strategy. Then the active strategy was started in 2019, and that's where we are right now. So we have a PMS, and we have plans of launching AIFs as well in the future.
Okay, the AUM would be around northwards of 150, 200 crores as we speak.
Total AUM is around 700 crores, but the active strategy is about 200 crores as we speak.
Got it. And I'm guessing you take charge of all of those. So tell us, Mr. Sundaram, what's your investing style? I mean, for the benefit of our viewers, I know a bit about it because of the conversation that we had yesterday. But what's your investment style, and why do you believe that is the style that will work for all seasons, and particularly the current investment environment that we have?
Yeah, see, let me preface it by saying that there is no single best style in investing. There are several ways in which one can successfully invest. I happen to follow one style. That's the crux of it. If you look at it carefully, many styles will fall under two broad categories. I call them trying to get it right method or trying to avoid the mistakes method. So these are the two broad categories. The trying to get it right method, if you're following the fundamentals route, there are several things that you have to take care of. You have to first estimate which industry is going to go the fastest. Within that, you have to estimate which company is going to grow the fastest. Try to estimate the revenue growth, try to estimate the profit margin, try to estimate the impact of the competitors' moves on this company's profits, try to estimate the earnings per share growth, etc., etc. And finally, after all these things, try to estimate how much of all of this information is already in the price. So these are the things that are necessary to succeed in the trying to get it right method. The point is that there are hundreds of variables to be taken care of in this method. Now, the important point to remember is that there are hundreds of highly qualified and intelligent people trying to do just the same thing at the same time. Everybody is blessed with roughly the same level of intelligence. Everybody has access to roughly the same information. Everybody has Bloomberg terminals nowadays. Everybody has modern computerized databases. Everybody attends the same analyst meetings and the same conference calls. Everybody reads the same journals and the same annual reports and the same newspapers and magazines. So it is very, very unlikely, in my humble opinion, that any single person will have an edge in terms of information in this competitive age. So that's one part of it. The other method, which is equally effective but far less complicated, is to try and avoid the major mistakes. See, if we avoid disasters in investing, that leads over a period of time to a pretty decent result without subjecting the investors' money to significant levels of risk. That is the method that I'm talking about. When we speak of disasters, as far as the equity investor is concerned, there is only one disaster. and that disaster is permanently losing money. That's the only disaster that is an investor can suffer. And permanent loss of money is happening only as a result of four factors. So if we take care to avoid these four factors, if there is a process to avoid these four factors, it leads to an enhanced level of returns without subjecting the investors' money to unnecessary levels of risk. That is the method that I'm talking about.
Okay, we'll evaluate this method as well, Mr. Sundaram, in a bit. But I just want to kind of juxtapose all that you're saying with the current context as well to have people make a better understanding. So my question, therefore, is: uh, uh, is there a did your method differ, or has your method differed when the indices were reeling at near 7,500 and there was doomsday all around in the investor's mind? And is it different currently? It's a very short time frame, I know, but it's a very large difference in the sentiment and the valuation levels then versus the sentiment and the valuations level now. As somebody said, in a matter of a few weeks, I think we've traveled a few decades in 2020. So
Yes.
how is it that you looking at the current context versus what was there in 7,500? And then, of course, we'll talk about the things that people should do in order to avoid mistakes as well. The four factors that you spoke about, but we'll do that a bit later. Can we talk about the current context currently?
Yeah, see, the approach to investing remains the same. Whether the index, that is the beauty of this method. Whether the index is 7,500 or 12,000, it doesn't matter. What matters is what we buy, how much of it we buy, and at what price we buy. These are the only three things that matter. So this method is not dependent upon the level of the index. That's the whole beauty of it.
Sure.
It's
Okay, I
remained
get
the
that.
same.
Okay, so let me try and put some context out here to what you just saying and trying and second guessing, and then you please correct me. So, are you saying therefore that let's say at 7,500, for example, uh, what would have been what could have been possible mistakes would have been betting on companies that may have the valuation comfort, but the growth was a big question mark? Because I think when I see from 7,500 to about 11,200, what the markets have duly rewarded are the companies that have been able to show some growth or show the promise of growth. And at the same time, people have also bet on companies that were having the valuation comfort, but the outlook was a bit hazy.
Yes, see, the only difference between the two things you're saying is the time horizon involved in the fruition of the investment process. Right?
Right, right.
If the investment process is to buy something that will give a return within a month's time, then this method will not work. But if the investment process is to look at companies that have sustainable business models and which can be expected to give returns over the next 3 to 5 years, then this very much works. That's the point here.
Okay. So do you sense that in the current context as well? I mean, I'm guessing a natural outlay of what you are suggesting as an investment strategy would be to not necessarily follow the herd and in some extent try and be a contrarian. Am I reading it correctly?
See, it is like this. Let's carefully look at this. You're right. I'd like to take it a little further. What the
Sure.
point that you're making? I'm just like to take a little further. In every form of investment activity, in every form of economic activity, a low price is considered attractive enough for purchase.
Right.
Unfortunately, in the stock market, when the prices fall sharply, many investors say stay away. It's a contraindicator of the whole thing. It doesn't make sense according to me. There are many methods which follow the trend, but I am saying a low price, the low entry price enhances the chances of investment success. That is the whole point behind this method. And as long as you choose a business that is sustainable, a business that is competitive, a fall in stock market, a fall in the stock prices, it should trigger a purchase, not a sale or staying away at that time. That's the point I'm making here. But the contra of that is that when the prices become too expensive, or when the level of expectation around the sector or the stock becomes extremely high, then that indicates that the stock is too expensive, and that is a signal to stay away from it. That's the in that sense it is quite different from some of the methods that have been followed in the stock market.
Yeah, I mean, especially the last decade, Mr. Sundaram, we have to admit that, I mean, value investing in that sense hasn't quite reaped benefits, right? I was reading a Bloomberg story which was comparing the decades, and 2010 to 2019 seems to be a lost decade for value investing. So, why do you
Let,
reckon that it will pay
see, uh,
dividends
uh,
currently?
uh, yeah, I'm glad you asked that question, because value investing is defined in various ways. I think that the wrong definition is to is to describe value investing as buying cheap stocks, buying single digit PE stocks, or high dividend yield stocks, or low price to book value stocks. That is not value investing. Value investing is buying something of quality for less than what it is worth. That is value investing, right? In other words, don't deviate from quality. Don't buy junk simply because it came cheap, but buy something of quality when it isn't too expensive. That is the I think that is commonsensical, and that always works. And you spoke of the last decade. Let's take, about a decade, and just over a decade ago, we saw the end of one of the wildest bull markets you have seen in this country, right? The big bull market ended in January 2008. We all remember that. In January 2008 or December 2007, the sectors that were having very, very high levels of expectations in the investing world's mind were infrastructure, real estate, construction, power, and so on and so forth. These were the sectors that were, having extremely high levels of expectations, and therefore extremely high levels of valuation. Even during that time, there were sectors that were extremely ignored, good quality companies that were ignored, and therefore available at a reasonable price. Instead of buying the popular stocks of the day, if one had just stuck to buying, companies that were out of favor, the subsequent years saw a very good return from these stocks. I can give you other examples. You remember in 2017, the flavor of the season was mid and small caps, right? Almost everybody had a huge proportion of mid and small cap stocks. But the same mid and small cap sector was available at far cheaper valuations just 3 or 4 years earlier, but there were not enough takers for that. The mid cap index has a long term average of just under 20 times. But in 2017, the same mid cap index went to a PE multiple of more than 100 times. And the maximum interest, the maximum, passion to buy mid cap stocks happened in 2017, which was precisely the wrong time to buy mid caps. But my point is this: even during the bullish mid cap times, there were companies that were available. Today, such companies are extremely popular. But in 2017, such companies were completely ignored. So, my limited point to you, Niraj, is that in any market environment, there are a segment of companies that are ignored or neglected or forgotten for reasons that we believe are temporary. If it's a terminal problem, obviously we shouldn't buy it. But if it's a temporary problem, and if there's nothing wrong in the competitive position of that company concerned, a temporary problem gives us a good entry point. That's the point I'm making here. In that sense,
Okay.
value investing will never go out of fashion.
Hmm. Okay. Fair point. And viewers, keep in mind, towards the second half of this conversation, we will talk about the four factors that people should keep in mind to avoid the
Okay.
big mistakes. So we'll do that for sure, viewers. But since we
Okay.
are on the topic of how in every market environment there are good companies that might have temporary problems. So what is it, if I may understand from you, Mr. Sundaram, that in the current environment you would be bent towards doing? Would you be, for example, look at the flavors of the last 3 or 6 odd months, because everybody talks about this world as a pre-COVID and a post-COVID world and not the normal world. So therefore, in a post-COVID world, are you do you believe that more allocations would be done to say sectors like pharma, telecom, media, technology, because all of these seem to be the ones that will sustain without any questions in the minds? It's almost
See,
given that they will do well, versus there are pockets which in your mind might have temporary issues currently and therefore might be available at a good valuation. Where is it that you are more bent towards?
yeah, it's an interesting question. During the sharp fall of March, April, we increased substantially in the pharma sector. Or just before that, we increased substantially in the pharma sector. I think the pharma sector is unlikely to be affected too much by the COVID, especially if there are companies in the chronic therapies. They are unlikely to be affected too much by the COVID problem. COVID problem is a serious problem. Let's not discount it. But the issue is there are businesses that are capable of sustaining even during these COVID problems. And when some of these were available at prices below their historical average valuations, that is the time to just stock upon them. But the other part of your question is, are you looking at sectors that are ignored by the rest of the market and having a big position in them? The answer is yes. If you look at our newsletter, we have a significantly large overweight position on industrials. Industrials are not the most popular sector at the moment, but we think that strong, good quality industrial companies are the ones to buy now, especially since they have not lost their competitive edge. They are going through a phase which I think is bad, and we believe it's temporarily bad. And some of them are available at valuations well below their long-term historical averages, and that gives us the comfort that they are available really cheap.
Could the belief also be because that the consumer spending is going to be a question mark world over? Maybe B2B and therefore manufacturing, etc., might be the flavors for the next 12 to 24 months. Does that tie in with your thought process?
See, there are several things here. Do we believe that manufacturing and industrial activity in this country will be permanently impaired? I don't think so. India has a very, very strong automotive industry. India has a very, very strong textile industry. India has a very, very strong, requirement of infrastructure and construction. So I think that there is all these sectors at some point of time have to restart the investment phase again. And if you look at companies that will benefit from the increased investment in all of these phases, there are companies that are not dependent on any single sector, any single sub-segment or any single subsector. Any improvement in industrial activity will benefit these companies, whichever sector it is. So if you focus on buying companies like that, I think that's the whole point here.
Okay. Now, the other big question is, if I look at all the examples that you gave me of 2007, 2017, 2018, you've clearly mentioned that you've avoided what seemed to be not necessarily the flavor of the season, but the hype of the season. Where in the current context do you believe that the markets are really bullish on those, but you believe that either due to the business cycle or due to valuations or due to other factors, there might be merit in examining the hype in the spaces?
See, let's take an example of about 2 years ago. I can't give you live examples because I think it's a sensitive topic. So I will give you an example of a very recent example, which happened about 2 years ago. You remember the NBFC and housing finance sector boom?
Yeah.
About 2 years ago, or just even less than a year ago, the financial services sector was occupying 40% plus of the Nifty index. The fact is that financial services contribute less than 14% of India's GDP. And there were several stocks that were trading at 8 times book value and 10 times book value. I found it incredible that a finance sector stock could trade at 10 times book value. And therefore, we took a very, almost a zero position at the NBFC sector 2 years ago. Until the NBFC boom lasted, we were underperforming. But when the NBFC boom ended, our stance was, the merit of our stance was seen by everybody. That's the point here. When in any market environment, there are some stocks that are extremely hyped up, or everybody is talking about it, and therefore the expectation around that stock is very high. If the expectation is very high, the chances are that it is very expensive. And when you buy when it is very expensive, the chances are that you will not make money subsequently. So this is the approach that we follow.
Fair call. Okay. What are you mentioned at the start of this interaction that there are four factors, I presume you said, which people should keep in mind in order to avoid the mistakes. Can we wrap up this conversation with those so that people can keep them in mind?
Okay, there are only four. Number one is investing in a company that is having a weak or a deteriorating business. So value investing is not buying cheap. Value investing is buying good quality, but companies that are not hyped up. That is important. Number one is there are parameters, strict parameters, which in subsequent conversations we can define what those parameters are. So there are parameters of track record, there are parameters of balance sheet strength, there are parameters of competitiveness of that company or the profitability indicators and so on and so forth. So ensure that your money is not going into a weak business or a business that is not competitive. So that is the first mistake that you should avoid. Number two is look at companies where the management of that company has not shown any tendency of going against minority shareholders' interests. So it is not enough if the company has the competence to make profit. It should also have the willingness to share the profits with minority shareholders like you and me. And this we can judge only by the track record. If there's anything in the track record that suggests that minority shareholders' interests have been seriously compromised, then we should avoid that sector. The third mistake is paying too much for the stock. And this is the most common mistake. However good the company is, however great the business is, if you pay too much for the stock, then the subsequent returns from that stock are not going to be good enough. So there are methods in which we can measure whether the stock is too expensive or not. The measurement that we use is we compare today's valuation to its historical average valuation over the last 10 years. And we also compare it to the estimated sustainable growth rate in earnings of that company. If today's valuation is more than one standard deviation higher than its historical average, we stay away from that sector. It's okay. We may lose a little bit of the upside, but that's okay. As long as the bull market lasts, we may underperform for a while, but that's okay. Everybody underperforms at some point of time. The last mistake is behavioral. And the last, I think, is the root cause of the other three mistakes. And this is being bothered too much about how much money somebody else has made. I think, if the investor is interested in having the best investment product, as opposed to having a collection of good investment products, I think that is a serious error that leads to investors making serious mistakes. A best investment product in a highly bullish market environment will probably have an overweight on the most popular sector of the day, which means that the portfolio will be expensive. So as long as we take care to see that there's a process in the investment process that reduces the chances of these four errors, we will not do too badly for ourselves. That's the takeaway from this. And in my experience, I think the biggest mistake that investors generally make is to make the best an enemy of what is the good. It's important that investors choose good investment products. It is not necessary, nor is it possible for investors to choose the best investment product, because the best is an ephemeral thing. It keeps changing every few months. The best keeps changing. So instead of that, if you have 3 or 4 good investment products, and if these 3 or 4 products are different from each other, that gives the diversification the client really needs. And if not all products need to be the same, indeed, they should not be the same. If they are the same, they will rise together and fall together. If, on the other hand, the investor has 4 investment products that are different from each other, then in 2020, maybe one product will do better. In 2021, maybe one other product will do better. And it gives us the spread of the risk. That is important for the investor. That's the whole point.
Fair call. I hope people can actually imbibe some of these, maybe all of these, but at least some of these qualities in the personal portfolios as well, viewers. So I hope you take some leave out of this conversation. But Mr. Sundaram, it was a pleasure chatting with you today. Thank you so much. And we look forward to have you more of your wisdom on subsequent shows as well.
Thank you for inviting me. It's a pleasure talking to you.
Pleasure is ours. Yeah. And viewers, thanks for tuning into this edition of The Talking Point.